这样吧，我给你一个承诺，如果说你买回去，你觉得效果不好，不满意，7天啊7。
Hey everybody, this is Jose Blasco. I believe you should be able to hear me. Could you please confirm all is good with sound? Okay, everyone, I'm just gonna put myself here in the bottom right side of the screen as always. We are ready to get started. I do need confirmation just to make sure you guys hear me. I have been having a series of technical problems on my end, which I'll discuss in a moment. But what's urgent now is that I know you hear me. So today I'd like to request more than ever a confirmation that you guys hear me well. I'm just doing an initial test before we get started because I think things should be okay. But again, I need to double check from you guys. Hello, Joe. Good to see you, and thank you so much for this message. I am just doing a final confirmation here on my end, so please bear with me, guys. We are about to get started. Sorry for this delay start with the various issues I had on my end. Okay, but yes, it seems that things are working normally now. So we are going to start right now, everybody. Very good. Perfect. Okay. Welcome to the session, everybody. Today it's December 1st, 2021. Not the best way to start December with a few technical issues, but let's use a little bit of humor, even though this is not really funny on my end. Welcome to Options with Options. My name is Jose Blasco, ready to begin the month with options trading and more. Before we get started, I would like to highlight the disclaimer, as we always do, so you can read it carefully because it is indeed important information. Trading is serious stuff. There is risk involved. Probably you know, but even if you know, this disclaimer is quite healthy for you to read. Counting on you to do so. Agenda, we're going to be looking at the market. We're going to be reviewing the trades that we have. We have some discussions to be done because we had a little bit of a break with Thanksgiving, and therefore we need to catch up. And from there, we'll move into planning new trades. Okay? Very good, everybody. Very nice. So I am now closing the introduction slide, pointing at tradewithufos.com/Jose, which is the page that you may want to use when you have questions. When you come to this page, you have a question and answer section here in the bottom part. So you just click on the purple button, you log in, and then you'll be able to click on the green button to ask questions. You have to be logged in to be able to ask questions. You don't need to be logged in to be able to search among the prior questions, which have multiple answers already here waiting for you, so that you can do it without logging in. But for you to pose questions, you do need to log in, okay? Cool. So with all of this in mind, we are going to now move to top and begin our market analysis and our trading sessions. How are you, Joe, Joanne, Mario, everyone? Good to see you guys. And again, for the ones of you joining right now with a little bit of delay, just wanted to apologize for the technical issues that we had on the Thanksgiving week. That was not ideal to have to cancel that session. And also having technical issues starting today. You know, we've had, this is a difficult world, isn't it? The world is becoming a bit too difficult, I would say. We had major DDoS attacks on our website, all sorts of things going on. Yeah, not so much fun. But anyway, that's the world in which we live. So apologize for that, because obviously this has created some negative impact on you guys sometimes not being able to log in today, starting with some delay and things like that. And well, again, I won't extend. I'm sure you feel my frustration here, so I won't extend this this conversation. But sorry for that, guys. I'm definitely looking for some stability on our systems, because we had some issues recently. Okay, guys. Cool. With all of this said, let's get into market analysis. So what do we see? So what we see is a down climate, which is currently confirmed. We are in this climate for a total amount of 3 candles. Statistics suggest 2. It's a normal statistical duration. Thank you so much for your support, Christian. We are indeed tough, and as traders, we know that, patience and other characteristics are what makes us good. So I guess we are all good, but at the same time, we meet a couple of times a week, and I really like to make the most of it. So yeah. Anyway, so we are in a down climate. 3 is the current number, which surpasses 2. In other words, we should expect the climate to come back to be blue any moment. We actually have, using today's candle, we have a potential Elliott wave turning point. Remember, the Elliott wave turning point is not confirmed until the candle closes at the end of the day. So it's a bit too soon to call it a turning point already. But tomorrow we're going to meet again, so we're going to be able to confirm that. But definitely, if we have that Elliott wave turning point, and tomorrow price starts trading above that high, which coincides nicely with the EMA, then we're going to be able to say we are in a blue climate, and everything changes now from red to blue. Okay. One more indication here: when you look at the maximum value that we achieved when we hit the top of that particular red line, that value hit 168, where statistically speaking, 0.82 is what we would call too far, too fast. So in other words, when we reached that low, the speed at which the market was dropping was classified by AutoClimate as way too far, way too fast, and therefore it classifies as not sustainable. And I guess it's why we're having such a powerful bounce today, 1.73% up. Again, it doesn't mean anything unless the climate changes, but it was kind of expected, because of, when a market is traveling at that speed, normally, again, it's not sustainable. Okay, so we should be expecting the market to go back to normal very, very soon. Normal meaning blue climate, which is what's happening most of the time for the longest duration when you compare 6 versus 2. That's what I mean. Okay, Mark, I forgot what the long down bar is on AutoClimate. The long down, this is basically the indication of a change of climate coming. Okay, so when you see a very long bar like that, typically the next day you have a change of climate. Long bar like that, change of climate. Long bar like that, change of climate. So almost always when you have a long bar, then it follows with a change of climate. You may have these weird situations that happen extremely few times, where you may have a couple of those long bars. That could happen, but it's really, really uncommon. Normally, one of those gray bars in the bottom part will lead to a change of climate. Okay. Yes, very nice. Ahmed, how are you, my friend? I'm just noticing your message above Mark as well. Nice to see you all, my friends. So anyway, so now, while we are in that situation where a change of climate is likely going to happen, I want you to notice that the implied volatility for the puts is slightly above the implied volatility for the calls. It's not a very big difference, but we do have a difference, 19 versus 18. Okay, so in other words, we gotta be careful. Okay, so you could certainly see that down climate continue for a little more, because at least from the options markets, when looking at options data, we can see that there is still a little bit of a bearish component as an average. Okay, because remember, here what I'm looking is at the 3-day average of the implied volatility for the calls and the puts. So as an average, we are still seeing signs that show that there is a little bit of a bearish bias. Now, when looking at what's happening today, okay, we can totally see many more puts being traded compared to calls. Okay, and the put volume is being surpassed, the call volume, the call volume, the average call volume is not being, price is not coming, not even close. So in other words, while the market is moving higher, it seems that the amount of puts that are being traded is superior by far. As an average on the last 3 days, the implied volatility for the puts is greater than the calls, which suggests puts are being bought, not sold. In the 5-day average, we see the same thing. So in other words, with all of this, we gotta be careful here, because this may be looking like the bearish sentiment is not over yet, and this may just be profit taking, because many people are entering positions to the short side, or betting on a bearish move. Okay, this is not so common to see so much put selling, so much put buying at this moment in time. Okay, now when I look at the implied volatility for the calls and the puts without any average, we can also see how the puts are 19 and the calls are 17. So even if you look at it without looking at an average, you look at raw data, what's happening now, all is pointing at puts being bought or calls being sold, and the quantity of puts surpasses big time the quantity of calls. So careful, big note of caution here, because again, with such a big move, the climate, 3 candles. So we've seen that many times, and now you would expect something like that to happen, right? We'll move like that, and next thing you know, someone may not want to miss the move and just get in. We gotta take it easy. We need to see confirmation for that Elliott wave turning point. We need to see confirmation for a blue dot to appear before we rely on a new climate, because while statistics suggest a change is about to happen, even the max distance, as we discussed a moment ago, suggests a change of climate big time. The reality is that the options data is suggesting the complete opposite. Okay, so we gotta be very careful. And in my mind, and we're gonna see that right now, when there is so much uncertainty or so much contradiction, typically it also means fear, and that would normally translate into a pretty high value for the VIX, which in this case is 22 point something real time, which is obviously, with the market going 1.75% higher, it's lesser than 27, which was the prior trading day, but definitely it's pretty high as a value compared to what we're used to if you look at the VIX range, in the past, a few months. So in other words, with my planning of trades for today, my favorite approach would be to begin the day looking for non-directional opportunities where we will be selling options, and therefore I'm looking for iron condor type of setups. Why? Because there is a pretty unanswered question here, which is the market going to go higher or start going lower? So non-directional gives me wiggle room for me to navigate through that uncertainty until the climate defines itself. And in the meantime, because implied volatility is high, I should be able to find setups where selling options are going to pay nice. Okay, so therefore that's my preference today when it comes to planning trades. Okay, cool. So hopefully all of this makes sense, and if you have any comment or question, that would be a great time for you to type it on the chat box now. Yeah, I see there are no new questions, but I will be looking at the chat box in case you have comments or questions. Second portion of our session is now to look at the positions that we have and discuss what to do with them. Okay, well, KBH, I left it there just because we had a technical issue on the session we were supposed to conduct last week. We were not able to do it, and therefore I was not able to discuss. But KBH was going to expire, 2 Fridays ago, isn't it? I was going to review it last week, but I could not. And we know what was the outcome of this trade. This trade is a trade that worked against us, and it produced a loss of $143. That was the end result of the trade, and this trade is over. Okay, so I'm just going to delete it. There is nothing else to comment. We talked about it. We talked about everything about this trade, but I never had the chance to remove it from my position panel because I never had the chance to meet with you last week. COF, it's a different story. COF is a trade which is currently profitable by $42, okay? Even though that stock has been a little naughty, okay? So let's take a look at that. If we look at COF, and we move, I believe we planned this trade on a 2-day time frame or something like that. Yeah, it was planned on the 3-day time frame, exactly, 3-day time frame. So we were relying on this particular UFO to put on a trade, right? And so for a while there was a little bit of a good reaction, and then it went down, then it went back up on that upper week, and then it went down pretty aggressively. And today it's up by almost 3%, amazing move. But really, even though that's the case, you can see how that stock really went much lower than what we wanted. Okay, and definitely very far from the target that we would like to achieve. Okay, very far from that. So now, if you recall, because this is a trade that we already worked on it, we already managed the trade by creating multiple tweaks. So this is a trade where we started selling 2 series of bull put spreads in order to finance a long call. And then as the stock moved in our favor, so we managed to close the puts and we managed to sell a call against the call we own. When you see, let me zoom in here. For the ones of you that may not remember or may not be in the trade, you see many rows here because I wanted to keep everything so you guys got to see the execution prices, because I did that a day where we were not meeting in the session. So I wanted to document that for you guys. But basically, the only thing left in this trade is this. Okay, we are long a 174 call, and we are short a 179 call, which basically that's a bull call spread. So if you look at my Thinkorswim account, and we look at COF, oh, you know what I said is not accurate. I guess I did not document this adequately. So yeah, now I remember. So we had, okay, here. So we had the 174 call, and then we sold the 179.4, which that I said correctly. But then on the last session, what we did, because the market kept going against us, so then we decided to butterfly. The bull call spread, which I guess human error. I forgot to copy and paste that risk profile on top, right? So notice how we butterfly it, and I know that because we have a -2, and then we have a +1, okay? And therefore, you can see how the net P&L of this trade is +14. To be honest, it's more than that. Why is it more than that? Because we already closed the initial puts and everything else for a profit, so the net result is more than that. But what we are left with in the account is that that butterfly. Okay, so what's the outcome of this particular trade? Let me see. Yeah, I don't know what I remember now what my mistake is. I kept it in a risk profile window, but then I never got to change it to the position graph. So I'll do it now. So I'm just gonna get a risk profile of my bull call spread. This was the risk profile of a bull call spread. Okay, so this was a trade where the most you can lose, the most you can lose is actually a profit of 26. So we could not lose on this trade, and if the stock was to move higher, you could profit all the way to $500+. That was what we had, and then because COS started going down, then we butterflied it. So when we butterflied it, basically what we had was this. Not that. What we had was this, where we now came in here and we added 2 more units. One was to buy, one was to sell. Okay, so we sold another one of the 179.4, and then we bought the 184.4. Okay, you guys please confirm to me on the chat box if you did that conversion, you are in this trade, you are butterflied at this moment in time. I'm not sure this is proper English, but you get my point, and that way I know where you guys are. Okay, so when I did that, yes, let me load my execution ticket so I can tell you exactly the prices I got, because for the 184 call I can see that here I had to pay 63 cents. Okay, so for this one I had to pay 63 cents. Okay, but for the new one that I sold, I don't know. I only know my average price. Okay, so let me get my order ticket. I'm just looking for this. Just give me 1 second. So the order ticket was here. here, the ticker was here. Okay. So that was done on the 5th. On the 5th, no, and that's not possible. Give me a second, guys. I'm just looking at. Sorry, because I got confused. I guess I had this prepared to review last week, and since we didn't, and it's so many trades, guys, I just want to make sure I don't say the wrong thing, so I don't get you confused. Okay, so let's do that. The price I got for the 179.4 call was 149, and if you look at Thinkorswim, okay, my trade price is 124. If you get 2, I got 124. In other words, if you get 124 times 2, okay, so 124 times 2, and then I subtract 149, which is the price I got in the first one. This is telling me that the second time I did it, I got 95 cents for the second call, okay? So I'm just basically reverse engineering it. So when I did the butterfly, I basically sold that 179.4 call at 95 cents, and I bought a call above 189.40 at 63 cents, okay? So if I do that and if I add it, now you will see very clearly the new risk profile I have, which looks like that, okay? So now, if the stock keeps going lower or stays the same, so I am gonna make $58, okay, as a minimum. And if the stock was to rally, so the most I could make, remember, when you have a butterfly, the maximum profit you make is in the middle part of that triangular shape risk profile graph, which in this case coincides with the short strikes, which is 179.4. So if that market was to rally hard towards 179.4, so whenever I get there, I will want to exit, and I will make whatever profit it is depending on the date, because there is a time decay element that will impact my trades. Okay, so very good. So that's what we have. Okay, so I'm just gonna copy this one now, and I'm just gonna put this on the position panel. Okay, right there, following COF. And again, it's many rows, but again, what really matters is the 4 units in the bottom, where you are long 2 of the units and you are short 2 of the units, which is the same 179.4 call. Okay, this is what you need to remember. Okay, and therefore this is your butterfly. This is what we have in the account right now, and therefore when you look at the net PNL, instead of 42, we're having a net PNL of 95 now, which is again accumulating everything that we've done so far. That's the PNL that we have in the account. Okay, cool. Mark is in the butterfly, Joe is in the butterfly, Christian is not. Got it. Perfect. Thank you for confirming that, guys. And sorry for my mistake here, because I remember keeping that risk profile window, and then I guess I forgot to do what I just did, which is to copy and paste here so we can track it. Okay. But anyway, hopefully this is now clarified. Then the next trade that we need to review is Yelp, and this is a trade that didn't work well. So far, it's showing a negative PNL of $64. So let's take a look at that with Yelp, and let's see what to do if anything needs to be done. So with Yelp, we entered using the 89-minute time frame, if I am not mistaken. And I want to show you the vertical line I placed on the chart, which represents the entry. Okay, so this is a trade that for a while worked a little bit in our favor, and from there really started working against us very badly. Okay, so again, during all this time, what should you do? Well, you should manage the trade the way we are learning it. Okay, the way we are learning it. Bad news, we didn't meet. So because we didn't meet, I didn't do it. Okay, so we are at a disadvantage because we could have done better with the management of this trade. But let's face it, this is also a good situation, because as human beings, maybe you were sick that day, you could not trade. Maybe the stock simply gapped against you by a large amount, and therefore having price far away from our entry against us would be a similar situation. In this case, it happened because we didn't meet last week, but in this case, it would be a similar situation to having the stock gap against you. So what can you do? When that's the case, what can you do? Okay, so that's a good exercise for us to cover, okay? So first, let's go back to the risk profile, okay? So we understand what is it that we have in our hands, and that way we can talk about it, okay? And I'm just gonna ask you guys for 1 second, and I'll be back in just 1 second. Okay, well, maybe it was 3 or 4 seconds, but I'm back. So what do we have with Yelp? Well, with Yelp, we are long a 35 call, and we are short a 43 call. So what's that? Well, that's a bull call spread, isn't it? And therefore, if that stock goes up, we're gonna make money. If the stock goes down, we're gonna lose money. Good news, the amount of money we're gonna lose is limited to what you pay for the bull call spread, which in this case was $355. That was the amount of money paid for this trade, okay? So the P&L of this trade right now shows us minus 85 on top with the differences on how platforms calculate P&Ls. On Thinkorswim, it shows as minus 87.5, kind of the same, okay, right there, okay? And therefore, we are losing a little bit of money, okay? Now, of course, while this is not a good news, remember, the way we selected Yelp is because that stock belonged to a strong industry, so it's not like the world is ending. Next thing you know, you may have a very strong push and the stock goes your way and you're back in business. I mean, look at the size of this up candle, for example. This is not a weak movement to the upside. So this often has a lot to do with what the sector or the industry or some competition stocks are doing, which are acting as a magnet, acting as a catalyst for Yelp to move back to where it needs to be, and we are back in business then, okay? But at the same time, it's not a good thing when the stock is moving against you for a long amount of time, especially because if you were to look at the climate, so the climate is red, extended, 8 is way more than 3, so in one hand, you would expect the climate to come back down, but maybe that stock, it's really changing its behavior to become much more bearish and much less bullish. Maybe it still belongs to a long industry, but it may be the weakest guy of the whole industry, okay? So that could be the case, okay? And you may want to call that Murphy's Law, but these things happen, okay? So the question is what to do, okay? Well, just like COF, it's a very similar scenario with COF, where we had converted COF to a bull call spread, and then we butterflied it, because then we ended up having an additional level of concern of that stock may not be reaching our target because, now that stock is showing a lot of weakness. So then this is going to be the approach I'm gonna apply and see if that makes sense or it doesn't, okay? Now, when we plan this trade, let me float this window. Let me take a look at the drawings that I had. So when we plan on this trade, we were looking at a target around either 44, right? Or if we were relying on this Elliott wave turning point, which doesn't make sense anymore because that dotted line was crossed, meaning that Elliott wave turning point fell. So if we were to plan on this Elliott wave turning point, that yellow box would be the target. So maybe 41, maybe 43 would be the right place where to exit, something like that. And that's why, the option that was sold was 43. Again, I believe that we use a strategy builder to build this trade, if I'm not mistaken, and it's many trades, so I don't remember everything. But you can see how this is kind of like the target where we plan to exit. So what's going to happen if I butterfly it? Well, let's compare spreads, copy the primary spread. So now on the bottom part, I got the same as the primary spread. And now I'm going to butterfly the second one so I can compare the outcome of butterflying versus non-butterflying. So let's edit the spread, okay? And let's see how is it going to be, okay? Let's see how is it going to be. So if I butterfly it, the way to butterfly, remember, quick review, okay? So a butterfly with a call means you have calls above, you have 2 calls in the middle, and you have calls below, right? So right now we have 1 call below, we have one of the short calls in the middle. So in order to butterfly, we need to sell one more call in the middle and buy one call above. So in other words, I'm going to have to add two legs. Okay, one is going to be a sell, and the other one is going to be a buy. And the distance between 35 and 43 is 8. So I'm going to sell one more of the 43 at the current price. And then above the 43, $8 above, which would be 51, but it doesn't exist, so I'm going to go for 50. Then I will want to go ahead and buy a call above the call I sell. Okay, and guys, I'm so sorry, but I'm going to have to turn off my video stream 1 second. Hey everybody, sorry for that. For whatever reason, I don't feel too well today. So sorry for that. But anyway, so we are buying the 50 call. Again, ideally you would find the 51 strike, because the 51 strike would be exactly $8 above 43. But it doesn't exist. We have 50 and 55. So I'm gonna start with 50 and see what happens. And when I do that, remember with the midpoints, because I'm gonna evaluate what if I do it at the current price, which another way to say current price is midpoint. So I'm gonna click OK. And this is going to bring the strategy below, which is now being seen with an orange risk profile graph instead of blue. Okay. So now, what is the situation here? What is the net outcome of this trade if we were to do that? Well, if we were to do that, what we are accomplishing is that let me put my cursor, anywhere in here in the losing area. Okay, I'm looking at 31, 53, 56. Because it's kind of like the losing area. I mean, what if the stock drops a lot? So if the stock drops a lot, on the expiration day, which is February 18, the orange trade, which is the new one, is going to lose 287 instead of 355, which is the original trade. Okay, so good news, if we butterfly it, we are going to reduce the risk of the trade. Okay, that's the good news. Okay, good news as well, if we were to reach the midpoint, okay, if we were to reach the midpoint, the amount of profit you would make in the original trade coincides with the blue line, where the amount of money you would make with the butterfly would be the orange line, which is a little higher. Okay, so in that sense, it looks like there is potential to make a bit more, and there is potential to lose less. Okay, so in that sense, you would say, okay, let's do it. That's it, done. It's all advantages. Well, it's not all advantages. Okay, that would be great, but it's not all advantages. Notice the real-time orange line, and notice the real-time blue line. So let's say we reach the midpoint of the triangle, which is 42, is 43. Okay, it's 43 because it's the strike of the calls that we sell right there, right here. Okay, so if we reach 43, notice how if you reach 43 right now in 1 minute time, you're gonna make some money if you don't change the trade. Now, if you reach 43 right now in no time, your butterfly will actually lose money. Okay, why? Because you have two calls working against you. Okay, so that's a problem. Okay, that's a problem. Okay, so the question is how likely it is to reach 43 in 1 day. Okay, so we can go ahead and run an estimation. We can just point at 43 here. Okay, and right click to send to the strategy builder. Not because we're going to build a new strategy, but just to have a time to target type of estimation, which shows is going to be on March 1st. So it seems that reaching the target is not looking like it would happen before the expiration on February 18. Therefore, with that in mind, then yes, I am indeed very happy and inclined to convert my bull call spread into a butterfly, because even though if I was to reach the target today, I would be at a disadvantage instead of an advantage, the reality is that reaching the target today looks like extremely unlikely. It's more looking like it's going to take place all the way somewhere in March. And notice how the dates pass. Now, you reach that midpoint, and now both trades are going to give you a profit, okay? Even though the maximum profit will be reached, the closer to the expiration date, the better. And now the orange risk profile graph is going to pay you more, okay? So in this sense, because we're in defensive mode with Yelp, I would indeed be happy to explore this possibility, okay? Now, Yelp is not the most liquid option chain in the world. So, of course, I want to make sure my entry is going to be very good, because if my entry is not going to be that good, so then it's not that ideal, okay? So what do I need to do that? So I would want to, again, I'm just going to re-summarize it here. I will want to use the February 18, sell the 43 call and buy the 50 call. This is how you will do your butterfly, and that seems that this will provide 62 cents of credit, where the bid would be 60, the ask would be 65. Again, let's see how easy we get filled on that one, okay? So let's put it in the system. So I'm gonna go for Yelp. February, and selling the 43 call and buying 50, okay, which this is supposed, I mean, here it says it's supposed to provide 70 cents of credit. I would say less based on what we saw earlier, isn't it? 1 second, guys. Back with you, my friends. So let's see what we get. Okay, again, 70 cents is what I think Oswin is stating with delay data. 62 cents, it's more like look like a real time. So I'm gonna try with 62. See if I get that. Okay, confirm and send, and then my Yelp will now be butterflied, okay, if that's the case. Okay, so just waiting to get filled. I'm asking for 62 cents, mark is 70, haven't been filled at the moment. This may mean that the amount of liquidity is not that amazing, so 43. Let me take a look at top. Here, let's take a look at that chain for Yelp using February 18, using 43 and 50. And we believe probably we had no volume today or something like that, and that's why we are having a tough time to be executed. Exactly, 0 and 0. So there is open interest, but no volume so far. Okay, so that was my concern, and therefore you guys be super careful. Okay, do not rush it. Remember, there is no rush. The most you can lose is limited in the strategy no matter what. So just wait the whole day. Even if you try tomorrow, even if you try the day after, just get filled only if you get a good price. If not, don't get filled. Okay, don't rush it. Don't speed it up, because it's not urgent to do it. Okay, I may do it myself on my end just so I can demonstrate and keep showing you how to do your management. So the days we don't meet, you have seen it and you can do it. But when you do this with a real account with real capital and you see volume is 0, doesn't mean it's a wrong stock to trade. It just happens that those strikes are not that liquid, and therefore you're gonna have a worse time getting filled. Okay, so don't rush it. Christian, you got 82 in credit last week for this tweak. Wonderful, and I'm very happy to hear that you were able to do it by yourself. You thought about the rationale, you thought about the process, you applied the process. So wonderful, wonderful, because obviously today you would be, 20 cents at a disadvantage, isn't it? So good one. Okay, very, very good one. So anyway, I'm just going to leave it there and come back to review what happened before the end of the session. In the meantime, this order is there waiting to get filled. Let's see if we get the fill or we don't. Next trade that we need to review. Okay, next trade that we need to review is, go back to positions, is CSX. Okay, so CSX, it's a similar situation, even though it's very different. Okay, so CSX is a trade that we plan utilizing, I believe it was a larger time frame. And again, that stock is bouncing very aggressively to the upside. Unfortunately, I think I don't have notes of when we entered. I guess I did not document it on the screen. My bad. But, oh yes, I do. We did document it. I just documented it on the left. Here we go. Yes, correct. So we entered at this moment in time. This is where we entered. And, we were supposed to continue to the upside, but it didn't. Okay, the market went in our favor for a little bit and then turned against us. So again, same story. As the stock started moving against us, we could have tweaked it sooner. Okay, we didn't, which is okay. But let's take a look at what is it that we can do now, given the fact that we didn't meet last week. So if I look at the risk graph, this is a bull put spread. Okay. Now, the one thing you will notice, though, is that the risk profile of a bull put spread is exactly the same as the risk profile of a bull call, because both strategies are bullish, both are limited risk, limited reward. So the risk profile looks exactly the same. And of course, if you go back to your basics in options trading, you know that. Okay. And if you have forgotten it, hopefully now you remember. Okay. But now the very big difference is that this trade is collecting time decay. This trade is a credit instead of a debit. While the risk profile is the same, characteristics and how it works is different. So good news is that if the stock just goes just a bit higher, the break-even point is 37.23. So as long as the stock just rallies a bit more, on expiration, we're gonna make money, which is right here. Okay, even though before expiration, as long as the stock rallies to 36 point something, which is not too far from the current price, we may be back in business. Okay, but same story. Okay, same story. When the stock started moving against us so aggressively, it's kind of like you lose a little bit of trust on the capability of that stock to move towards your target. And therefore, a very smart approach is to explore, what if I was to butterfly it? Okay, but wait a minute. We cannot butterfly it the same way we did with the bull call. Why? Because it's not calls, it's puts. So how do you butterfly a bull put? Well, to butterfly a bull put, you cannot just convert a put strategy into a put butterfly, just like we converted a call strategy. Sorry, guys. I need to apologize for a moment. Hey everybody, I'm back. Not the best. Sorry for that, guys. I feel a bit embarrassed, to be honest, but I'm really not feeling well. So there are times where I do need to disconnect myself for a few minutes, okay, or a few seconds. Sorry for that. Anyway, so what I was saying is, when you are dealing with a bull call spread, right, which is made of buy a call. Okay, so bull call spread, okay, which is made of buy a call and sell a call above, right? So this is your bull call spread. We just talked about it. To butterfly it, you just end up buying a call above and selling a call at the same strike where the call was, okay? So we just talked about that. But what's the problem now? The problem now is that you're not dealing with calls. The problem now is that you are dealing with puts, okay? So the strategy you have is, you are short a put, you are short a put, and below you are long a put. So how do you butterfly the bull put spread? Because if you butterfly it with puts, then it becomes a directional put butterfly, which is going to be bearish. It's not going to be bullish. How can you do that? Well, then, to be honest, you'll see it's easier than what it looks like. You are just going to do the same thing. You're just going to buy a call and sell a call. In other words, instead of going from a bull call spread and converting that into a directional call butterfly, you are going to go from a bull put spread to an iron butterfly. Keyword iron. Iron means you are mixing calls and puts. Okay, a call butterfly is made of all calls. An iron butterfly is mixing calls and puts. Okay, so that's the one difference that we are seeing here. So really, the process is exactly the same, but it may confuses you because we haven't done it too often in the sessions to butterfly a directional bull put. Remember, this was a bull put, but it was directional. It had a pretty intense quantity of delta when we built it, right? I believe, if you recall, this trade was in the money, if I remember well. So this is a case which I'm not sure if we had this case in the past. Again, it's many trades, so I don't remember everything, but definitely it's a new situation that may get you confused if you are doing that by yourself at home. And I want to point at the fact that the way to deal with it is exactly the same as if it was to be a bull call spread, because the risk profile is actually the same. But at the same time, from a strategy point of view, you end up with an iron butterfly instead of a call butterfly. Okay, so could you please, guys, confirm with me that you are with me on this difference? Because I'm basically saying the same thing with different words, but the different words matter because if you use the wrong options, then you have the wrong strategy. Okay, so in this case, terminology is very important. So let me compare and build the iron butterfly out of the bull put spread, which will be done by adding two legs, where one you sell, one you buy. Up to this point is all the same, but now instead of puts, we're going to use calls. And of course, I'm going to go for the midpoint, the current price of the new units I'm going to add. And I need to also make sure I got the right strike. So 38.3 is the one I am selling with a put. So 38.3 is the one I will be selling with the call. Very nice. Thank you for that, Mark. Thank you for that, Christian. And then the one above, well, if the distance between 38 and 36 is about $2, so above 38, I'm going to look at above $2, okay? And it's looking like I'm going to have to pick 40. It's not going to be exactly the same. 41 would be too much, 40 too little. Again, you have decimal strike prices, and in this case, we won't be able to be that precise. So I'm going to try with 40 and see what happens. Thank you, Mario. And I'm going to click OK. Okay, so what's the result of this trade now? Okay, what's the result of this trade? Joe, wouldn't an iron condor be more directional? Yes, but you would also reduce less the risk of the trade, because you are selling further out strikes, therefore you're going to get less premium, and therefore you're going to protect less what if you're wrong. Okay, so you're going to protect it less. The iron butterfly, because you're going to be using the nearest strikes as possible that don't hurt your profit taking. So because you're going to be selling the strikes that are the nearest as possible, so you're going to get more premium, and therefore you're going to be protecting more the case in case you're wrong. Okay, so in this case, and I'm happy to simulate that, so you will see that in a moment, Joe. Take a look. So when you look at the orange outcome now, so instead of losing $56 worst case, now you are losing $33.5 worst case. And same story, if you reach the midpoint, which is 38.33, so the amount of money you're going to make is a bit more than what you would make if you did nothing. So again, it's looking like it's making sense. The disadvantage is the same as we saw earlier with Yelp. The disadvantage is the same, okay? That if the market was to move too far to the upside, notice how the real-time value for the blue risk profile is much higher than the orange. So the question is, how long it would take for that market to reach 38.33, somewhere here. So if you send it to the strategy builder, this is telling you that a good estimation for target would be January 10. Okay, January 10. So let's take a look at what if we reach our target on January 10, because expiration is January 21st. Okay, so we may reach before expiration. So January 10 is right there. Okay, and in this case, if we reach that target of 38.3, so you will be dealing with a profit of $21 instead of a profit of 53. So you'll be profitable. That's the good news. The bad news is that the size of the profit will not be that impressive. Okay, that's the bad news. Okay, so is it worth it to do? Well, in this case, I would say no, and I'm going to explain why in a moment. Okay, because I have two reasons for it. But before I do that, I want to also illustrate Joe's question by getting another strategy here, which is going to be sell and buy with the calls, with the midpoint. Okay, and now instead of doing 38 and 40, which is the same I did before, so what if I do 40 and then I go for 41.67? That would be an iron condor. Okay, that would be a directional iron condor with a little bit of positive delta. Okay, here we go. But now notice how, that was my point, that notice how now if you're wrong, worst case you're going to lose 48.5 instead of 56, where in the prior case you would lose 33.5 versus 56. So you have a much more efficient reduction of the risk. Okay, guys? Back with you in a moment, my friends. Hey guys, I am back. Sorry for that. So anyway, Joe and everyone, but especially Joe, since you asked the question, is that now visual and is it clear for you how, yes, your point makes sense, but at the same time, it has that disadvantage, okay? And in my case, I was in that defensive mode because that stock didn't behave, right? So I lost some trust and now I am in defensive mode. I want to give the stock a second chance. Indeed, I want to have that risk profile with a positive delta and make money on the way up. But I really want to protect myself and reduce the risk given the fact that the stock didn't behave, okay? Now, very good. Thank you for that confirmation, Joe. Now, why is it that I was saying that we're not going to do it? Well, the reason why we're not going to do it, okay, I'm going to go back to the two type of trades is because, look, this trade has a maximum risk of 56, okay? Yeah, fair enough. If we do the butterfly, we're going to cut it by half, or, not half, but like 40% less, something like that. So it's pretty powerful as a cut, okay? But I'm gonna miss on a lot of performance in case I'm right, okay? That is not too inviting, because now in this case it does look like we can reach the target before expiration. It was not the same case with Yelp, where it looked like, based on the time to target estimation, it looked like we would not reach the target before expiration. Okay, well, in this case, it looks like we could. And then the difference in performance would hurt me. But there is another reason for this. Because this trade is so low risk, which is only $56 per contract, and let's say you are, you want to risk, I don't know, $500 per trade, and because this trade has $56 of risk, you are in this trade with 8 or 9 contracts. So if I was to do this, and I happen to reach my target just a bit sooner, okay, let's say you have a strong push and you reach the target a bit sooner and you have to close and exit the trade, I may now end up getting slippage and have to pay commissions for 9 contracts, right? instead of, you know, much less, right? Because it's only 2 units instead of 4 units per trade. So I'm not, you know, when a trade is such low risk, the beauty of low risk is that it's low risk, but the problem of low risk is that now you need to use many contracts per trade if you want to have a decent profit, depending on your account size, your risk management rules, and so on. So because of that, you know, I would not be inclined to do it, because that would imply that if I reach my target soon, next thing you know, I need to kill the trade, and it's going to be like so many contracts to close, so many commissions to be paid, and potential slippage and all of that. So I would prefer to leave it alone, let the trade play out. Again, I lost trust on the stock, okay, because it didn't behave, but it still belongs to a strong industry if we got a stronger push to the upside. So I may consider closing the trade for a small profit, or then doing the butterfly when it went higher, as long as my butterfly now puts me in a position where I cannot lose, like the one we have with COF, where that horizontal line is above the 0 line instead of being below the 0 line. Okay, so in this sense, trade management would not apply yet for this trade. If you have done it before, so then maybe you got a better price and it makes sense. But doing it today, the answer is it's better to pass. And finally, we have Philip Morris. Okay, so that one is a trade that did work beautifully. Okay, so we entered at this moment in time, and since we come in, that stock has been dropping crazy. And today, actually, the stock is moving against us by 2.87%, because that was a bearish opportunity, taking advantage of a new climate that propagated beautifully well. Okay, at the time you had the puts above the calls, blah blah blah. So you know, this was a neat and beautiful trade. Okay, actually, we surpassed the target. Okay, our target was located way closer, if you recall. You know, we had the Elliott wave turning point, all those things. So we wanted to take profits way sooner. I didn't, okay, and therefore I didn't because we didn't meet, but we can now go ahead and close this trade, because staying in the trade now would basically be hoping nothing else is going to happen. And the reality is that, remember, the S&P may change to a blue climate, so now that stock now that's been profitable for a while may end up now giving you a loss. Okay, so it doesn't really make sense to keep this trade for longer. Let me take a look at the risk graph. This is also expiration date December 17. Okay, so we are here. That's where we are. Okay, we could afford for the stock to go back all the way to 90. Okay, and that would be okay. But again, if the stock goes higher than that, now you start suffering this down line. And if the stock was to surpass this price point, now you may end up in the red territory. So we don't want to be greedy. The normal action would be to close it. I'm going to do an extra analysis just because the volatility went higher. Okay, so if the volatility went higher enough for the strikes that we need on that particular stock, we may actually end up finding a better solution than closing the trade now and tweaking it to something else. But typically my expectation would be that closing it is going to be the best solution, and I'm just going to analyze another solution just because I didn't close it on time. I should have closed it like a week and a half ago when we had the opportunity when we met target. Okay, but since I have it in front of me now, so let's see if there is something better I can do. So if I close the trade now, I'm going to get a profit of $90-something. That's the real-time profit of the trade if I close it now and I exit at a fair valid price. What if I don't close it now and I do something else? What else can I do? Well, I guess you are guessing it, right? I can butterfly it. Okay, I can butterfly it, but in this case, remember, this is a bear call spread. Okay, this is a bear call spread. You sold the 90 call and you bought the 92.5. So this is the opposite example of what we had before. Before, we had a bull put spread that we butterflied. Actually, we didn't. We decided not to, but we tried to butterfly it by making it an iron butterfly. Remember, it was not a bull call, it was a bull put. So instead of a call butterfly, we made it an iron butterfly. Well, in this case, it is a bear call. It's a bear call. So to butterfly it, okay, because it's a credit strategy, you would be thinking of doing an iron butterfly. Okay, And you could, to be honest, but I'm going to stick with calls. Why is it that I'm going to stick with calls? Well, the reason why I'm going to stick with calls is because this strategy is a strategy that this stock is a stock that did not move against us. It's a stock that has moved in our favor. So if I'm going to butterfly it, it's not because I'm trying to protect my risk. I am not in a risk position. I am in a profitable situation. I want to butterfly it in a way where I remain directional the most I can. I don't want to butterfly it as a defensive measure. I want to butterfly it just as a way to get more premium to see if I can make more, since I didn't close it yet. Okay, so it's a little bit of a different mindset. It's all common sense, so hopefully it makes sense. If you need me to repeat it or you need me to re-explain, happy to do so, but just keep that in mind. Joe, when a new low was made, would you add another speed bump? Yes, you could certainly do that. But if a new low is made, it means that the stock went down and then it came back against you significantly. That's how a new low is made. In other words, probably you missed your exit. And if you didn't miss your exit, typically that's when the stock is moving against you that will happen. Right? So in this case, it's just that we didn't meet last week and therefore we were not able to act on time. Normally, this case is not something that would happen, I would say, often at all, unless you have one of those crazy free falls, 20% gap down, and then the stock rallies against, right? And now you have a new low made. So that would not be too common, but certainly your thinking is 100% right, Joe. You are thinking about maximizing your profits, and I love the way you're thinking, and those will be the tools to use. Set the speed bump to define your new target. So let's go ahead and do it. Okay, I'm going to add two legs, where in this case, okay, so we are long the 92.5 call. We are short the 90 call, which we have from the last time. I want to sell another one. Okay, that's how I build the butterfly. I sell another call, and then I'm going to buy another call below. Remember, we are doing it directionally down. We're not doing directionally up because that market went against us. That stock went in our favor. So we're going to follow the stock with the next call that we're going to buy, okay, which is going to be lower by the same amount. And that's going to be 2.5, putting it down to 87.5. Okay, so if we do that, let's see what happens. Okay, okay, that makes no sense, and the reason why it makes no sense is because I didn't change this to buy. And now we're going to have a triangle shape, and that's exactly what I was looking to see. Okay, so what is it that we get? Well, now we have a situation where we cannot lose anymore. Okay, we cannot lose anymore, as you can see, where now, worst case, we're going to make $38. Okay, that's the worst case. Best case, you can make up to this value, which is about 250, but for that you will need the stock to bounce back a little bit towards 90. Okay, bounce back towards 90. So the question is that likely or not, or what? Knowing that our expiration date is 17th of December, which is 15 days from now. Okay, about around 15 days from now. So let's take a look at the chart and do a little bit of technical analysis here. Okay, so first of all, we have a case where the climate is 10 out of 4, so that's very exhausted. We reached 2.12 out of 131, so that's very exhausted. Okay, and therefore we should have a bounce, but the puts are significantly higher than the calls, significantly. Okay, so in that sense, we should be able to see that stock continue moving lower. Okay, but before that stock continue moving lower, we may have a little bit of a pause, a little bit of a change of climate for a few candles before that happens. Let's look at what's happening on the volume map. And the volume map is clearly stating bearishness, even though that stock is moving up aggressively 3%, 3.1% in one day. All of this is very bearish. Okay, implied volatility of the puts significantly higher than the call. So in other words, that stock is more likely going to continue moving lower than going higher. It may give a little bit of a breather and come back up, but that should not last for too long. Okay, So maybe it rallies all the way to 90 because there are UFOs there, and from there it just crashes again. So if that stock rallies all the way to 90, right? So your current P&L, okay, your current P&L, if the stock rallies to 90, your current P&L, which is, let's call it 90, it's going to drop to 60. Okay? And guys, I'm going to have to ask you for a second. Hey everyone, I am back. So if that stock goes back to 90, okay, more or less here, so you're gonna make $60 instead of the current $88 we are making. Let's call it 90. Okay, so if the stock rallies and you do nothing, you're gonna likely lose a little bit of money. But if then the stock is likely going to continue going lower, so then you're gonna make more. Now, if you butterfly it now, the way I just said, which is a call butterfly, and the stock rallies to 90, you're gonna stay with the same P&L. So nothing's gonna change. Okay, you're gonna stay with the same P&L. Nothing's gonna change. Okay, but then if the stock continues going, then if the stock goes back to go lower, then you may end up with this lower P&L if the stock really drops aggressively. Okay, so the question is, option number one, exit now. Okay, which is probably the easiest one. And if you guys are not going to be watching the markets every day, so that would be the right action to be taken. Option number two, if you are an active trader and we have liquidity on these options, okay, let's take a look at the option chain for Philip Morris, December 17, right there. And we are looking at 87.5, 90, and 92.5. Those are the strikes we care about. Okay, the ones I highlighted in golden. So notice that we got 2 contracts, 4 contracts, 0 contracts. At the same time, we got 2,000 open interest, 500, and for that 170. Okay, so bid and ask 224, 246, 102, 119, 041, 050. So those options are okay from a point of view of liquidity. Okay, they are not amazing, but they are okay from a point of view of liquidity. Hey Clive, good to see you, my friend. So if you are active, okay, and you spend time in front of the market every day, so then I would say it's wise to convert this into an arrow butterfly. If it rallies to 90, okay, you are in the same place where you are now. And now if it goes higher than that, okay, because time is passing and the implied volatility will typically shrink, then you're gonna start moving. Instead of suffering the effect of this blue line going down, you're gonna suffer the effect of the orange line approaching the orange line above. Okay, so you're gonna start making more than 90, also because as time passes, look at what's happening to the orange line. Okay, so you may end up somewhere in here. So now instead of making 90, you are making 159. Okay, so it's a wise move, but at the same time, both to the upside and to the downside, what you don't want is that you don't want to see the stock to rally so much all the way to 92.5. So now you are back down here to your low profit of $30+. In other words, you would need to be watching this to exit manually in both cases, both if it goes higher as well as if it goes lower, because if it goes too low or it goes too high, then there is a moment in time where you're approaching this lower portion, okay? And that's not desirable, okay? That is not desirable because now you are returning money because of the negative gamma effect of a butterfly in this case, given the location of those strikes. So you gotta watch this manually, okay? So again, if you don't wanna watch it manually, probably the best choice is just get out. We should be out anyway because of the last week. So get out, get your $80, $90 of profit and you're done. If you want to manage this manually, then butterflying it makes sense, okay? Because we may end up profiting more from this trade while we totally remove the risk, but the risk now is that instead of 80, you end up making 30 if you do nothing, okay? So we need to manage it actively. So we may end up making 90 or more, all the way to 270 something, which is the maximum profit of this trade. Maximum, 278.5 is the maximum profit of the trade. I believe it is. So I'm gonna do it. Okay, so that way it will allow me as well to manage it and do more stuff for you guys in the sessions, because that's the things that you need to learn, the things that you need to get used to. By the way, I'm gonna try to replace that order, see if I get filled for a little less, so we can get in. Get one with Yelp, and while we're waiting for, okay, I just got it at 55, perfect. And I'm just gonna get now into this last trade, which is Philip Morris, using December 17, where we are going to butterfly it by selling another one of the 90 and buying one of the 87.5. I did it backwards. So selling, no, I did it rightfully. Buying the 87.5 and selling the 90. That's correct. Let me review, make no mistake. Selling the 90 and buying the 87.5. Correct. This is correct. This is correct. Okay. So we're gonna pay $1.34. Okay, because the call you buy is lower. You're gonna pay a debit for that. But remember, you are locking in, $250 of intrinsic value. Okay, which is the difference between strikes. So actually, it's that's why the P&L changes the way it does. Okay. So we're gonna do it. I'm gonna try to do that at 130, which is the midpoint. See if I get filled. And I just got filled at 127. So that's it. I got it. So let me update the portfolio. So let's not forget this time. So I'm just gonna edit. So how much we got for the 90? For the 90, we got 112. Okay, and for the 87.5, we got 239. 239. Click OK. That's your butterfly, and now I'm going to copy it to the positions panel so we can manage it into tomorrow and see what's going to happen with this trade. Okay, and then with the Yelp, I also got the execution for the Yelp trade. Risk graph for Yelp, and in this case we got calls. Okay, so that was 50, right? So we did 43 and 50, 80 and 25, 80 and 0.25. So this is the new trade we have with Yelp, and I'm just gonna copy the position to the clipboard. Sorry, to the clipboard, and then place it there in the positions panel under my original Yelp trade. So I have the second one here below. Very good. So my friends, this takes us to the top of the, actually more than that, more than the top of the hour, and we're gonna have to conclude the session here for today with this beautiful strong day to the upside, challenging the change of climate or not, challenging is going to be an Elliott turning point or not. So we're going to be able to review that together tomorrow. I think it's a great timing that this is happening today, so we can work on it tomorrow, looking for trades. Lots of management today, as was expected after 1 week with no sessions. So guys, very happy to have a little bit of time with you guys on with the options, with top, with the markets, and hopefully this was useful to you. See you tomorrow, everybody. You guys take care. Bye-bye, everyone.